Well, thanks for tuning into this budget special. Over the next 22 odd minutes, we'll talk to a very special guest who looks at the micro, the macro, the job scene, the economic scene, and lots more. He's Chief Economist, Axis Bank, and Global Research Head at Axis Capital. Neelkanth, so good having you. Thanks for taking the time out. Pleasure to talk to you as always, Neeraj here. Good afternoon, and I hope all is well.
All is well, Neeraj, and as always a pleasure talking to you. Thank you for having me on your show.
No, the pleasure is entirely ours. Neelkanth, standard question, of course, before we get into specifics, we want to talk to you about employment, skilling, and jobs in detail. But just a broad brush, initial thought, what stood out? Was it the fiscal consolidation? Was it cap gains? Or was it something else? I mean, do you think this budget was not about just this fiscal, but maybe a roadmap for the next few years? What stood out for you?
Yeah, so that's what I think is very important. This was the first budget of a new administration. So you wait for clarity, or you seek clarity on two major issues. The first is the fiscal priorities of the government, because there was this apprehension, or there was this expectation that the government would change its priorities, become more focused on fiscal handouts. It would be less focused on fiscal consolidation, or focus on longer term investments. The second big takeaway or expectation was what will be the priorities of the new government from a medium term perspective. So the first is the maths of the budget, and the second is the priorities in the budget speech, which are more longer term in nature. And I think on both these fronts, the government gave very clear signals that it is as focused as it was on bringing down the cost of capital in the economy by continuing to shrink its footprint, and also simplifying the rules, shrinking the role of the government, shrinking the discretion of the government in the economy on a whole variety of fronts, which I'm sure we'll discuss. So the priorities outlined by the finance minister in the budget speech, on which we will see more clarity in the next 6 to 12 months, were also very important, as was the fact that the government stuck to its fiscal consolidation roadmap.
Neelkanth, hi. It's also Samina joining in. At the FM yesterday listed out 9 priorities of the budget, the second of which was employment, skilling, incentivizing employers to hire first-time interns and, of course, employees in that sense, and also help skilling up the resources that are currently available in this country. How significant you think this is? Because Neeraj and me do believe and understand that this is something you've maintained for quite some time now, that employability is very, very important for a country to create the kind of $5 trillion economy or goalpost that we've set for ourselves.
Absolutely, and even the economic survey talks about the fact that only 4.4% of India's graduates have the required skill levels to be readily employable. So this is a major challenge for us. I think the economy is nothing but physical infrastructure and human infrastructure, and therefore, as much as we try to improve our roads and highways, we need to improve the quality of our human capital as well. In terms of near-term impact, I think we'll have to be a bit reasonable about our expectations. Remember that the total fiscal spend this year is about 10,000 crores now, which is a lot of money. But remember that this is also, 0.1 trillion rupee is a fraction of the $325 trillion rupee economy that the Indian economy is going to be. The output is going to be that much this year. So it's a very small number, and for it to have a disproportionate impact would be irrational to expect. But the one aspect of this government over the last 10 years has been that it signals its approach, and then it is absolutely relentless in trying in solving this problem using the feedback loop of does it work? It doesn't work. Then how can we tweak it? And I think the fact that the government has announced it as a big priority is I think a acknowledgement that there is slack in the labor market, and that it needs to be addressed. Now, whether these schemes by themselves will address the problem or not, time will tell. In terms of fiscal intervention, as I said, it is not very big this year, but one should expect that there will be more such interventions as the government doubles down on some of these in order to improve the labor market and employability.
Neelkanth, but allied things as well. I'm just trying to understand, because you wrote that very. It was an awesome report, I think a year and a half or 2 years back, right? Which spoke about how, I mean, quote unquote, not really, but the demographic dividend might turn out to be a problem if jobs aren't created. This whole thing about, I'm forgetting what it was, but 15,000 rupees which will cover about 210 lakh people is what the FM said. Then PPF incentives, employability incentives. I mean, so a lot of things done. I just wonder, do you reckon that there will be a relentless focus towards this job creation directly? Because hitherto capex in an indirect fashion, road building in indirect fashion was aimed at creating jobs. Maybe that is working, maybe that isn't. So let's go out and give a direct benefit to people and do it over a period of 5 years so that there is visible job creation and employment benefits being made. Do you think this becomes a cornerstone for the next all so many years?
Yeah, see, so if you think about the policy choices in front of any government, and especially at the central level, remember that these are not local governments or state governments, which have much deeper control and much more control on what really happens on the ground. So at the central level, when you are thinking about policies that need to solve for the slack in the labor market, the options in front of you are that you can either create those jobs yourself, meaning that you significantly increase and expand employment. And frankly, in every department today, there is the sanction strength, almost every department today, there is sanction strength which is much higher than that of the actual, so which is not fully there. And therefore, you can end up creating jobs by just hiring them yourself. But that would mean that you are increasing the burden on the taxpayer, your permanent and expenditure keeps going up. And if the government is running fine, despite being at, say, 2/3 or 70% of the sanction strength, then what's wrong with it? So that option was most likely considered and discarded, that this is not the best way to spend the money. The second is that you actually work with the private sector or you create conducive environment for the private sector by providing greater visibility into the future, by targeting macroeconomic stability, bringing down the cost of capital, reducing the compliance burden, and solving a lot of those things which I think have needed to be done for the last 30 years and have been done, and maybe we can try to accelerate that. So I think that is a much more sustainable and longer term thing, which I think has nothing to do with actual fiscal intervention, but a lot more about regulations. And I think there is an attempt to do that. The third, which is the schemes that you talked about, are that you reduce the friction or at least the uncertainty for the recruiter by saying, look, why don't you hire for the first month's salary? I mean, I'll take care of it. So you effectively say for someone, if they want to experiment with hiring someone for 1 year, your cost has been brought down by 12%. So that, I think, is an incentive structure. So basically, you kind of trigger that process of hiring, give comfort to people to grow, the companies to grow, and then maybe 1 year later they find, oh yeah, this was helpful. So the leverage impact can be there, but I think the biggest impact of this will be in formalization of the workforce, in the sense that people who would have been working without a contract, I mean, now given that these benefits are available mostly on the EPFO side or will be only paid for formal employees, this means that a lot of the workforce starts to get formalized. They start coming into the tax bracket. They start coming into the sector where pension benefits, provident fund benefits, and all of those start getting paid out. So my expectation is that this will accelerate the formalization of the workforce. The creation of jobs, I think, depends on how the investment cycle works. Remember that we have to create 1.2 crore jobs every year. I'm not sure just these schemes are going to suffice.
Neel, help me understand this, right? So maximum number of jobs are created in the labor-intensive sector. you mentioned that the economic survey indicated that employability for graduate level jobs is not very impressive. Now, also what we are seeing in the current context with the global forces is AI and technology that's replacing a lot of the gray and white collar jobs, and that's what's important for a company to turn profitable. So it's a tight rope to walk, I'd imagine. One, you want more jobs created, but you want them in the service sector where AI and tech is already playing a significant role. So how exactly is this going to work out?
Yeah, so see the transition period that India is going through. Remember that some of these concerns about AI and ML are, I think, much more elevated in economies, the developed economies, where a very large percentage of people are employed in some of the sectors which can potentially get disrupted by this. In India, where our first job is to move, about maybe 10, 15 crore workers from agriculture to something which on a per capita basis can generate much more value add. And I think the biggest and the easiest sector to absorb that, and this was the commonplace discussion point 20 years back. For some reason, it has, because the real estate cycle was so weak, we've kind of forgotten about it. But this is the real estate sector. This is the construction sector. And remember that as we think about Viksit Bharat, as we think about a developed economy, the difference between a developed economy and a developing economy is its capital stock. And capital stock is not just machinery. It is also urban infrastructure. It is also real estate. And construction is the best place to absorb tens of millions of semi-skilled workers who will be first generation transitioning from agriculture to something else. So I think as the real estate cycle turns, I do think that while real estate construction is also starting to get automated, but it will create, I think, more jobs. I think if the government can find ways to finance local governments better, provide much greater flow of funds. I mean, the fact that only 5% of fiscal resources in India go directly to city governments. In China, it is 50-55%. And in the third plenum discussion was how can we increase it further? The point being that if you can provide for that, there is enormous scope for urban infrastructure construction and therefore absorption of some of these labor forces. So AI and ML, I think, will affect some jobs, but in my view, if we use it well and it evolves in the way, and then we can adapt to it, it could actually create new jobs, because some jobs then could start getting the process of transmission of services jobs from the developed market, which is constrained for workers, to an economy like ours could actually accelerate. So that's an uncertainty. But I think the turn in the real estate market and the urban infrastructure revival are things that are completely under our control.
Neelkanth, from an equity market or risk assets perspective, does the capital gains tax hike, is that a big deterrent, or does the fiscal glide path at 4.9 negate it, or is it that a global investor will effectively eventually only look at valuations and earnings, and therefore already from T+1 we are back to valuations and earnings now?
No, from a perspective of sustainability of earnings, remember that the debt to GDP being very high is a risk to the economy, and investors will not be tracking it on a daily basis. This is an overhang. And the fact that there is better fiscal discipline and that the government is trying to sustain growth over a longer period. Recall that if for argument's sake, the growth turns out to be weaker than feared, and there have been questions asked that the government's projection of nominal GDP at 10.5% is perhaps too low, and that it can actually turn out to be higher. And the chief economic advisor in his economic survey had stated that we are talking about 6.5-7% real growth, and we are cognizant of the fact that this is below market expectations. So if growth was to weaken, it can be supported by restarting the fiscal intervention, right? So from the foreign investors' perspective, I think the we'll come to the capital gains taxes, but the visibility of growth, or at least the confidence in the sustainability of this growth is should be much higher because of some of these decisions that have been taken. Now, on the capital gains taxes themselves, remember that capital gains taxes only apply if you have capital gains, in the sense that if you were making 10% return pre-tax, earlier you were getting 9% post-tax, now you get 8.75% post-tax. I mean, if the returns were, say, 15%, maybe the impact is slightly higher, but the fact is that you're making 15%, right? So I don't understand. So other than the knee-jerk reaction that occurred yesterday, I don't understand the apprehension some of them have, or some people have, that, oh, investors are going to run away from the asset class. Because if the fundamentals, and you're absolutely right, it boils down to price to earnings, and most of it is pre-tax. If the expectation of growth is strong, or either on earnings or on PE multiples staying intact, it does not matter if the capital gains tax rate has been raised from 10% to 12.5%. Similarly, for real estate, there are people apprehensive that the removal of inflation indexation is going to make the asset class less attractive. I don't think so. I think the intentions to invest would be dependent first on what the pre-tax returns are going to be. And if those are good, the incremental investment will still go. And frankly, even if everyone thinks that equities are uninvestable and real estate is also uninvestable, then where is the money going to go? So I think the pre-tax gains are the primary driver of investment. Expectations of pre-tax gains are the primary drivers of investment. There is some reduction in distortion. So, for example, on things like bonds, I think the reduction in this distortion should help channel some of these savings away from equities over a period of time into bonds and all that. But that's, I think, the only adjustment I would make to that. But otherwise, I don't think really affects the returns for foreign investors.
Right. Neelkanth, this quick one. If an investor is watching you right now, somebody with an average risk profile, strategically, how would you advise them to invest their money? So what would be the asset allocation at current valuations, current levels between debt and equity? And in equity as well, would you advise sitting on some cash, keeping money liquid for a better opportunity? Or would you advise lump sum investing and then stagger the rest of it? And where would that bias sit? Would it be thematic themes one could follow, market cap cycles one could follow? Because even rotationally in the last couple of months, even defensives have played their part.
Yeah, on this, I follow the dictum that you should comment on things that you understand well. While it seems to be linked to what I do for a living, which is advising institutional investors on where the markets are headed and having some view on where the economy is headed, on how to distribute your assets between various asset classes. I mean, there are personal income advisors who are, I think, much better qualified, and I think they end up doing a much better job in terms of the percentage of allocation depending on which age you are at.
Okay.
What is the riskiness of your income? So, but I will not sort of run away from the question. I will try to answer it by saying that the equity risk premium in India is at a ridiculously low level. So well, I've been saying that for 1 year, so just that disclaimer. And that I would be better off buying bonds today than equities, given that the expected reward on what is supposed to be a much more risky asset class, which is equities, is not commensurate to the risk that historical returns suggest. Now, this correction may not happen very quickly. So as I said, I thought this is the case for the last 1 year. In my personal investment, that is reflected. That clearly, from a last 1 year perspective, has been wrong. But most of these things don't play out very quickly. And frankly, with your own personal investment, everyone has different levels of risk appetite, different levels of investment horizon. And beyond that, I think it'll be unwise for me to say more.
I don't think it will be unwise, but since you are saying it, we will accept it. But you've kind of given us food for thought, Neelkanth, and given investors and viewers who are watching you right now and subsequently on the digital channels food for thought for their investing, portfolio investing as well. Thank you so much for that. Thanks so much for all the gems this afternoon, Neelkanth. Really appreciate your time.
Thank you, Neeraj. Thank you, Samir.
All right. Well, that's Neelkanth Mishra of Axis. And with that, it's a wrap on this leg of this very special budget coverage. Thanks so much for tuning in.